Hey guys, it's Jordan here, and today we are going to be talking about growth stocks versus value stocks. You might be sitting there thinking, hang on a second, I just got started out and I thought stocks were stocks and that's all there is to it. And I'm here to inform you that they are different. It is not complex, however, it is very simple to understand, so let's jump right into it. The first portion we're going to be talking about is growth stocks. So these are generally capitalizing on the change in price. So you buy a stock at one price, sell a stock at another price. That's all there is to it, and you get the profit from the price difference. The second portion, which is a little bit different but still not complex, is the value stock portion, which is capitalizing on the price change, similar to growth stocks, as in you buy a stock at one price, sell on another. There is no difference. You still take the profit, but through your period of holding, so from when you buy to the time that you determine that you want to sell, you can receive dividends, which is a percentage of profits from the company that you receive as your percentage relevant to how much you hold. To ensure that you're getting the most out of your investment and to diversify your portfolio as much as you can, it is wise to start accumulating a portfolio containing both growth and value stocks. The whole entire stock market, every stock will fall into one of these two categories generally. A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. This means that the companies that are considered in this category are valued based on their forecasted worth. So they still take in the metrics of what they are worth now in terms of their assets, their liabilities, all that sort of thing, except they are priced on the share market in anticipation for where the company is going. Just remember that. That's a really key concept. Let's dive a little bit deeper into what sort of companies are classed as growth stocks. Some of the famous stocks that are considered growth on the ASX that I'm sure you would have heard of are Afterpay, Xero, A2 Milk, and Nearmap. So these are all considered growth stocks. There is a lot of growth stocks on the ASX, but these are probably some of the more common ones that you would be associated with. Heading overseas, and some of the famous growth stocks on the New York Stock Exchange consist of Amazon, Facebook, and Google. So these are all really well-known companies, really large companies, and same as I said before, there's a whole bunch of growth stocks on the New York Stock Exchange, but these are probably some of the more common ones you'll be associated with. So, in saying that, what is the significant difference between growth and value stocks? Many people think that the concept of a growth stock is that it is a very small company and they're an up-and-coming company and they haven't made it big yet, but that is simply not the case. The main difference between a growth and a value stock is the fact that the management of a growth stock generally invests all or any profits back into the business itself to enhance growth. This is a great method if you can see the company fits a particular need or a niche, such as Amazon selling products online or Google controlling most of the internet traffic market. However, it can lead for some stocks to be overvalued or expensive as they are operating off forecasted metrics. The growth approach ultimately means that companies never or very rarely offer a dividend to shareholders, which can be off-putting to some investors who generally like that extra bit of security, that extra bit of return. Dividends are a percentage of the company's profits that the company chooses to share with you, its investors. They are offered in terms of a per-share dividend, which can be anywhere from a few cents per share to a few dollars per share, depending on the company's size, obviously. Just to quickly recap, growth stocks, the main way you make profit is on the company's physical share change in price. So if you buy a share for $3 and sell a share for $3.50, your profit is 50 cents. Alternatively, for a value stock, if you buy the share for $3 and you sell the share for $3.50, but within the year you receive two payments of 25 cents, your total profit is $1. So you have the 50 cent change during the year and then you have the 50-cent change of the dividends, which takes your total profit to $1. Now to value stocks. A value stock is a stock that is generally traded at a lower price than its growth stock counterpart when comparing fundamental analysis. This is simply because of a dividend. So if you have a growth company and a value company, both the same price, generally speaking, a value stock will be a little bit cheaper, a little bit less expensive, simply because that dividend can make up the difference. And obviously, a growth stock is going to be valued on what speculators or investors think it's going to be worth in the future. Some retirees or people who wish to accumulate a passive income once or twice per year really value stocks. So they find them really helpful. Most stocks give a dividend 2 times a year. So if you have a portfolio worth a couple $100,000 or a couple of million in the future, generally you get some pretty serious dividends that some people even live off. Some retirees have a massive portfolio and they just live off whatever payments they get twice per year. And it is a very good strategy to have. Just to note a few famous value stocks that you may be familiar with. These are ones that pay pretty serious dividends throughout the year. They consist of BHP Group, Rio Tinto, and Commonwealth Bank. They are all listed on the ASX. They all give out dividends, and most banks will give a pretty generous dividend. This is not a very exhausting list. There are a lot of companies on the share market that give dividends, and it's well worth putting some research into which shares pay dividends if you are considering taking up the value stock approach. Just to note, some famous ones on the New York Stock Exchange also include Berkshire Hathaway, which is Warren Buffett and Charlie Munger's famous company, Procter & Gamble, and Johnson & Johnson. Again, this is not an exhaustive list. These are just a select few that I've picked that pay pretty generous dividends. Just to pay homage to Warren Buffett, famous Warren Buffett, who loves value investing, his quote of, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price," rings true when it comes to value investing. As I stated before, growth stocks are valued off forecasted metrics, what they think they're going to be worth in the future. Value stocks, that are generally, there is an aspect of that. When you have the price change, people are obviously going to want to make a return off the price change. So there is an aspect of that, but you also have the extra value of the dividend, which comes in twice per year generally. And that rings true in this instance. Just in a quick recap, when it comes to growth and value stocks, I think you need a portfolio that it has both in it, that is represented not equally per se, because some people are going to have a little bit higher risk tolerance than others, but a significantly even weighted portfolio of the two types, so you can get exposure to the growth side of the market and you can get exposure to the value stock side of the market. I think that is really helpful when it comes to first establishing a portfolio, a really balanced portfolio to give you returns that are quite handsome. I really hope you guys found this video helpful. I would definitely be interested to see if there's any other topics that anyone can think of in relation to the stock market or anything in general that you would like discussed down below. Thank you for taking the time to watch this video, and I look forward to seeing you on the next one.